Hello, everybody. Welcome to Clef Investments. Last week, we talked about the main investment method called buy, borrow, die. This week, let's talk about some small optimizations of using this method. So first, let's look at what to buy. Do you need to buy an ETF or mutual fund? Because you can get stock index ETF or mutual fund. There's pros and cons for each. Remember, this is a small optimization, so that if you already have a mutual fund or ETF, don't change it, because if you change, it generates tax. So what's the advantage of ETF or exchange traded fund? ETF generally has less capital gain compared to mutual fund, because if you buy and hold the ETF for a long time, in general, it doesn't generate any capital gain. But if you buy and hold a mutual fund, when other people sell this fund, it may generate some capital gain for you. So it's not very good. But Vanguard mutual fund is a little different, because Vanguard has a special patent allow them to exchange fund with ETF to remove this tax. Well, more on that later. So in general, ETF has less capital gain. So it's more useful in your taxable account. And ETF also often has lower commission, because you just buy and sell ETF similar to any stocks. And these days, many brokers allow you to buy, sell ETF or stocks with zero commission. And it works in any broker. So some mutual funds, they have limitations that they only work in certain brokers, and in other brokers, they charge a very high commission, like $75 if you want to buy or sell those funds. So ETF usually doesn't have this problem. And also for ETF, you can buy and sell in the middle of the day. It's just like a stock. You can set a limit order, you can sell at a certain price, but for mutual fund, you can only sell or buy at the end of the day, and you do not decide the price. You cannot set a limit price for mutual fund. So ETF give you a little bit more flexibility. And index fund also has some advantages. So first, it's often easier to reinvest the dividend of index fund, because the dividend can buy a fraction share of the mutual fund, so that you don't waste even a single dollar of your dividend. And index fund also allow you to buy a partial share. So for example, if you have only $100 to invest, you can buy a fraction share of mutual fund, but in most cases, you cannot buy a fraction share of ETF. So index fund allow you to invest to the full amount of your account. And for index fund, although Vanguard, the index fund has advantage, the tax advantage because of its patent, but the patent has already expired half a year ago. So likely other companies may produce tax-efficient index fund in the future, which has similar tax advantage as ETF, which means if you don't sell, it almost never generates capital gain. So we'll see. I don't see any this kind of index fund yet, but it may come out. So in general, if you have a tax-free account, whether it's IRA or Roth IRA, you can use fund, because there's no concern of having capital gain. It's a tax-free account. But for your taxable account, in most cases, ETF works better due to the lower capital gain. But some brokers allow you to buy a partial ETF share. In some cases, even if your account is small, you can still reinvest your dividend, and buy and hold ETF works fine. So those are the small optimizations. For tax-free account, use fund. For taxable account, use ETF. Unless the account is very small, then you use fund to buy partial shares. Another small optimization is to choose which index fund or ETF you want to invest. So in general, I would pick one with the lowest cost. So I listed some index fund I found out, and I listed the annual expense of those funds. So you can notice all of them are very, very low. And I compare each of these funds against the actual index, the S&P 500 index. And I feel that Vanguard did the best. It's most highest fidelity. It's closest to the S&P 500. So I would recommend VFIAX if you want fund, or VOO if you want index ETF. And VOO, V is a Roman number 5, O looks like 0, so VOO looks like 500. So you can remember, okay, this is 500. It means S&P 500. And if you want the total market index, you can use VTI. So those are very, very similar to S&P 500. I just picked S&P 500. And if you already have some of this fund, don't change. This is a small optimization. You don't want to sell it, change to VFIAX or VO because it will generate lots of tax. Well, unless it's a capital loss, maybe. Well, no, please don't do that because it's a substantial identical property, which means it'll trigger the wash sale. So don't change it. Just continue to hold it. We'll talk about tax harvesting, how to get the capital loss in future sessions. Okay, another small optimization I want to talk about is the dollar average down. So dollar average down is a very good strategy where you invest equal amount across the years, because as you get extra money from your salary, you invest regularly. If the stock market goes down, you buy more shares with the same dollar. And if the market goes up, you buy less shares. It can give you very good average performance with low risk. But are you really doing dollar average down? It's often not, because some companies, when they deduct your retirement account for 401k, they may deduct more in the first half of the year because you get extra bonus and they deduct from the bonus. But some companies do not deduct your bonus for 401k, then it's not an issue. But if you do, then in many cases, if your income is high, in the second half of the year, maybe your 401k is already full to the annual limit, then you are no longer invest as much as the first 2 quarters. So in that case, you could manually invest more money in quarter 3 and 4 because you invested less in 401k. So this gives you a better dollar average down. That's another small optimization. If you want, you can do. Another case is, how do you invest if you have a big sum of money? Like you get a big bonus, you sold lots of company stocks. What do you do? So there's one way is very simple. You just buy index now and hold it forever. Use a buy, borrow, die method. Or if you are afraid that the current point could be a market high, what would you do? You could use another changed version of dollar average down. For example, you could split the amount into 12 times, 12 equal shares, and buy once a month for a year, for the next year. Or you buy, split it into 52 and buy every week for a year. Or you buy every week for half a year, or so on. So I did some back test, did some program to do back test for S&P 500. And I found that if you do this, compared to buy index now and hold, you get slightly lower return, just slightly. But you also get a slightly lower standard deviation or risk. So yeah, makes sense because you spread out your entry point into the market. Both return and risk are lower because you buy later compared to buy now. The market on average goes up. So if you buy later, you buy at a higher price. it's end up to be a little bit worse compared to you buy index now and hold. Okay, so this is another very small optimization if you